So you get to see real estate agents financially naked every day. Is that right?
We do.
And because you guys do bookkeeping for agents and teams across the country, you have this wealth of data and information that's very helpful. You said one of the mistakes that agents make quite frequently is just not paying attention to their numbers, where they can be doing business and they're doing transactions and they think that they're making money. And then once you actually dig into the numbers, you recognize that that's not the case. Can you talk a little bit about, how you see that happen frequently?
Financials will always tell us a story. And I think the biggest thing that's important is to pay attention to your percentages, because they are going to give us the context of how much of our revenue we are spending in each category. And that's huge.
You also shared that sometimes you'll have clients where you'll see this trend where they're spending, the percentages are off and it's leading to very low profitability. And even when you point it out to them, people are resistant to changing.
Yeah, change is hard. And sometimes it takes a lot of effort. It's really just kind of people being hesitant to be uncomfortable. They say that growth doesn't happen inside your comfort zone. And it's really about stepping outside that comfort zone to make the changes that you need to push your business forward. But a lot of people just aren't comfortable doing that. They're happy where they are. They feel comfortable with the level that they're producing, and they're just not willing to take it to the next level.
Yeah. And it's interesting because I see that, in our coaching business from a kind of psychological perspective. And that's the lead measure. I share with people all the time that the psychology of the owner of the business is always the constraint on the business. And I see that in that area, but you see it in the lag measure. You see it in the weighing machine where you're actually weighing things and you're like, oh, this is clear that whatever your approach or strategy is not working.
Yeah. So your financials are essentially like your report card for your business. That's going to tell you how well your business is doing and what the financial health is like. And if you're, not paying attention to that and you're not actually utilizing those numbers to make your decisions, then that's a metric that you're not focused on.
Yeah. And I'm wondering, how much do you think that is? Because, I know that there's a difference between thinking like a salesperson and thinking like a business person. And business people look at numbers and charts and graphs and percentages, and salespeople are just worried about, I need another transaction.
Realtors definitely are a specific kind of personality. And that black and white, numbers on paper isn't always meaningful to them, or maybe they don't necessarily understand it, or it's more intimidating, something like that. There's some sort of barrier there. But I found that realtors tend to be very open-minded as well. They're very open to masterminding and advice and change. And you do get some people who are just not willing to make that change, of course, always. But, I find that realtors on a whole, just that personality type tends to lend itself towards, okay, you think I should do something differently. Let's think about that. Let's look at that. Let's talk about it.
I love that. And that's what makes you guys super different from any other bookkeeper, because I have a lot of, clients who have just like a CPA or something like that as a bookkeeper, but they don't know anything about the real estate business. So all they're doing is just measuring and counting beans sort of things to make everything balance out. But they can't sit you down and be like, hey, guess what? At your production level and with what you're doing right now, you're actually spending a little too much in this area. You may want to look at that.
Yeah. So we're definitely very real estate focused. We do all of our bookkeeping, kind of started around the MREA model and how that broke things down, but it's evolved since then. And so our chart of accounts is very, directed towards real estate. It has your commissions paid out to your agents. It has everything. It has your listing expenses in there, your listing marketing. So it's very much designed around real estate. And we, know the processes behind it. Like we work with virtually any brokerage. We've seen all of the brokerage reportings. So we really try to account for every single penny in your business.
Yeah. And I can kind of attest to being on calls with you and my wife where we're looking at, and you're showing me, that report.
Yeah.
So we can break down and see percentages. We can break down and see how profitable we actually are. Right. And that's incredibly helpful. So in a way, you guys are an extension, you guys are a coach in itself, right?
A little bit. I wouldn't ever claim to be a business coach, but, I think that the P&L the profit and loss can be intimidating to, your standard business owner, especially if you don't know how to read it. So, that's my job. I'm here to teach you,
It's super beneficial because, sometimes it's very difficult to see it when you're in it. And I love this idea that the numbers tell a story. Can you expound on that a little bit?
Yeah, the numbers tell a story. So, if I open up a set of financials and say I've never talked to this person before, the first things I'm looking at is, what is their cost of sale percentage? What is their total operating expense percentage? What is their salaries, their lead gen, net profitability? Those are kind of my 5 keys that I like to look at. Those things are going to tell me, okay, is this Rainmaker in production or not? If the cost of sale is running especially high, we have a scenario where the agents are doing more production than, the owner of the company. So a lot of times we'll go into it and I'll say, so it looks like you're not in production, and I'll get a, affirmative. So that's always really fun when I can kind of predict what's going on in their business for them. If salaries, depending on what that salaries percentage is, I can tell whether you're overstaffed with not enough agents to support the support staff, or, if we're really just running pretty lean with one admin and doing well in that regard. And the same for, lead gen and operating expenses. It just really kind of tells you, okay, where are the problems in these financials?
I'm kind of imagining what it can also show you very clearly is constraints. Like, what's the constraint on the business? Because I know if people focus on constraints, it's like the most leveraged thing you can focus on. Because once you figure that out, there'll be like a, 4, 5, 6, 10x like return on the time spent. So you can see people's constraints, whether, let's say they have a psychological constraint where like, I don't want to expand out and hire more people. So you can see it because they're lean and mean. They have like 1 admin or 2 admin and they're doing all these deals. It's like, okay, I understand your psychology, like the way that you're thinking. And if you want to grow, then you would have to address that.
I feel like I see that most frequently in lead generation. The thing I always say is you have to focus on your ROI. You have to know how much revenue you're getting from every lead source. Otherwise, how do you know if your marketing dollars are actually working for you, And I feel like that's a huge thing where people, if you collect this data, you have this amazing diagnostic tool, at your disposal.
You were sharing with me, like, of the 400 plus clients that you guys have, you have agents that are kind of individual, that are just kind of doing their thing. You have people that perhaps maybe have a few staff members and 1 buyer's agents, and then all the way up to these like huge kind of mega teams. So maybe you can talk a little bit about some of the things that you see with each group set, like with each category of agent.
When you look at the data on a broad spectrum, you'll see that, you kind of have people earning less than, say, 300,000 in GCI. That's usually a single Rainmaker. Maybe they have 1 buyer's agent, maybe, but that's usually a single Rainmaker. But then on the opposite end of that spectrum, you have people doing more than 3 million in revenue, in GCI every year. Those people tend to be large teams, lots of agents, maybe even Rainmaker out of production. And the really interesting thing is you see trends kind of on that spectrum. Like, you tend to have a higher profit percentage if you're a single agent. Whereas, 3 million plus teams, they tend to hover somewhere around 15% profit as compared to, maybe like a 35, 40% profit on a single agent. But really, when you think about it, dollar wise, 15% of 3 million is definitely a bigger number than, say 40% of 300,000. But you can kind of see those changes as it scales. You can see that the percentages kind of trend around the same way when it comes to, like salaries and education. They kind of tend to stay roughly within a few percent of each other, but those profit numbers really, really change quite a bit. And that's going to be because of your cost of sale. As people bring on team agents, they tend to ramp up into this higher, level of production. And then we're keeping less of our net, of our commission revenue. Not necessarily a bad thing. Like I said, 15% of 3 million is a much larger number. So kind of watching those trends across that broad spectrum is really, really interesting.
Yeah. And what you're essentially seeing happening is that people are buying back time because they're giving up margin in order to get their time back. Now, and I'm curious because I've seen, as these third-party kind of sharp-elbowed tech companies push into our space and they require more referral fees, increasingly 25, 35. So they're basically eating into potential revenue. So I'm wondering on your end, because I've seen it, all like in our own business. I've seen it in people that I coach where it's compressing the net. Are you seeing that on that broad spectrum as agents, like 20, 30% of their business becomes those referral sources?
Yeah, I'm not necessarily sure how much of their business really comes from those referral sources, but we do see those referrals, The most common one we always see is like Zillow, and their Flex referral program. That's really common. It's 35% referral. off the top of the commission. And that will really drive your cost of sale percentage up, because then, especially if you have team agents in the mix as well, working with those kind of referral-based sources, now not only are you sharing 35% with this larger company, you're also splitting the remainder with that team agent, somewhere between like a 40 to 60% split probably. I guess, again, you'd be wanting to focus on the ROI on that, know how much that you're paying to this referral source, so then you can compare it to the overall revenue that you've received. That ROI calculation can be really, really powerful.
Yeah. And are you seeing, like, because I'm aware that that's, a lot of, not a lot, but a good number of those very large teams are in a part of a program like that, because it allows them to scale out the agents and feed them, like kind of have a large flow of transactions, but you're giving away 35% of all the revenues. So how are you seeing teams have to adjust for that? Or are they just lowering the splits that they give to the agents, or like what's happening?
No, not necessarily. Usually what I'll see is that if they do go towards one of those programs, I'll see a reduction in the, general lead gen expense, like outbound marketing dollars. Because really what's happening is, you can kind of see the difference. It's a 35% referral on essentially, a guaranteed closing. You're not going to pay them that 35% referral if you don't close it, as opposed to something where, like in the past, those larger companies were more of like a pay per lead kind of structure. That's something where you could pay for that lead, and then if that lead falls through, you're just out that dollar. That's a bad return on your investment. And so I have seen people shift kind of more towards a referral basis rather than, pay per lead. But, again, it's usually just a reduction in lead gen expenses. It really doesn't, it just drives our cost of sale up, and it really doesn't affect the team agents very much.
And then, like you said, at that level of the spectrum, you're seeing like a 15% profit margin. And then if we back down to, let's say, the agent who has like a team and maybe like administrative staff, and then like, I don't know, like a buyer's agent or something, maybe two. What are you seeing in their numbers?
So what we do is we like to break it up into income ranges, because that tends to work very well. So we break our ranges up to, up to 300,000 in GCI, from 300 to 550,000 in GCI. And then we go 550 to 800, 800 to 1.5, 1.5 to 3 million, and then 3 million and up. So we like to break it apart into those 6 kind of different ranges, because those ranges kind of tend to put certain people in certain buckets. So 300 to 550,000, that tends to be, those teams that are kind of ramping up. There's maybe like between 1 and 3 buyer's agents on that team. Whereas when you get into the higher levels, then you start to see more and more agents come on. You see that cost of sale percentage rise typically, and then you'll see, profit margin go down in proportion. So yeah, for that 300 to 550 range, where it's maybe like 1 to 2, buyer's agents, their profitability tends to be, somewhere between 30 and 40%. It's lower than the single rainmakers, but not quite as low as, say a rainmaker out of production, a 3 million plus team.
You guys noticed as the marketplace shifted that some of those percentages started to shift dramatically, like in the third and fourth quarter. I don't know if you have data, because we just had the first quarter.
Yeah. So I don't have that data for this year yet. I do have it for 2022, which I found really interesting, because that's really where we started to see the market shift, was in 2022. So I'll actually share some info with you. We have some data here. This is based on our database of real estate teams. It's about 460 clients. And what we've done is, we have 2022 here, each individual quarter, and then grouped by range. So you can kind of see, Q1 and Q4 seasonality wise tend to be slower in general for the real estate market. Some years are weird and they throw off that seasonality, like, the 2021 post-COVID market was just absolutely insane when it came to seasonality. Not normal trends at all. But this year became a little bit more normal. So you can see that, Q1 had decent profitability for all these buckets, somewhere around, and you can also see that they, tend to trend downwards in percentage as you get larger and larger. But really what was interesting is we had a spike in Q2 for most of these ranges. Their profitability went up. So production was good in Q2. We still had a lot of closings happening. We still had a lot of, hot sellers market.
Right before the rates started to go up.
Right. And then Q3 is really where we started to see that impact of the market shift. And you can see that in the profitability. Q3 for every bucket dropped. That's that white bar here. So it
Yep.
dropped for everybody. And then Q4 was interesting, but it was definitely very, very low. You can see you went from 42 to 35, 40 to
Hmm.
23. So these dark red bars here, you can really see that drop in every level, every team, you know.
I guess I'm wondering too, because my experience is having been selling real estate since 2006. So I went through, this was more like I don't know, like a hiccup, not like
Mm-hmm.
a complete collapse.
Mm-hmm.
That when, Warren Buffett has a saying that when the tide goes out, you could see who's wearing pants or not.
Mm-hmm.
That what it really does is it reveals operators. Like if you're not a good
Yeah.
operator, it becomes painfully evident very fast.
Yeah. And I mean, I hear that all the time from realtors. I feel like there was an influx of realtors, around that kind of post-COVID time where homes were selling themselves. It was very easy to get in. You didn't have to have a whole lot of, I don't want to say skill, but you didn't have to have a lot of
You can.
experience to sell a home,
Yeah.
But as that tide started to turn and those, the interest rates started to go up and that, super hot demand started to die down, we saw a lot of those realtors start to panic. We saw them start to kind of drop down in production, and now it's not so easy anymore. You have to put in the work. And so what I
Mm-hmm.
found is that a lot of my, kind of seasoned realtors were, I'm not worried. They weren't scared. They were ready. They thought this was going to be a good thing for their business because now we're seeing increases in inventory. We can actually get buyers into homes, whereas the newer agents were a little more panicky.
So people ask me all the time, they're like, Aaron, how are you on all of these different social media platforms all at the same time, all at once? I can't get away from you. The truth is that I have a strategic partner that helps me with this. They're the folks over at EC Creative. And they not only send me the ideas, they also do all the editing and posting. So what looks like it takes hundreds of hours per month to do is really only taking about 8 hours per month. So if you're interested in finding out some more information about EC Creative, DM me the word social. Yeah, that's interesting. And then I'm wondering too, because you get to see people financially naked, I remember sitting in a room, it was like a mastermind, and they were looking at numbers to see of a very large franchise. And then I want to ask you about models because you see underneath the models and you see which ones economically serve operators the best, is that there was one key characteristic of a very large franchise. They had like 30 or 40 of them closed during 2008. And the one thing they all had in common was that their rent was very high and their space was very big. It was like the unifying, common denominator. So, and I'm also aware too, because you mentioned one of the things that agents do a lot that's a mistake is like commingling. So we're like in this very interesting position in where we really are running this business, but we're also trying to pay personal expenses and we have business expenses at the same time. So being a really good operator means paying attention to both. So do you ever say to people when you're looking at their personal expenses, like, hey, bro, I don't know what you're doing, but you're like burning cash like it's your job?
Not necessarily. I try not to pass too much judgment. Everybody's got, a dirty closet in their house, right? And so, but
you
it's
can
true,
see it, right? I have to imagine like it's plain as day. You're like, oh yeah, you're just like lighting cash on fire.
Yeah, no, it can be pretty obvious. And so those are the scenarios where if they are lighting cash on fire like that, they're probably commingling. They're probably mixing business and personal together. And I think that that's very, very important to separate. First off, that's the number one thing that we tell anybody who comes into our company. If they're commingling when they onboard with us, we ask them to, do everything you can to stop that as quickly as possible, because that's going to just not give you accurate information. Now your data is muddy. What's the burn rate for the business? What is we call them break even numbers. We say, here's your operating expenses for a 6-month time frame. If we just average that to get you a baseline, here's your number. Say that maybe is 10K a month. Then what you do is you build your personal expenses into that. You need to understand how much it takes to run your personal household, just like you need to understand how much it takes to run your business.
Yeah, I think that's really good guidance. And I know you can't change what you don't measure. So like being really, really clear as an operator, of, hey, what does it cost me to operate my house, and what does it cost me to, or just living expenses, housing, transportation, food, and insurance, like the four things that eat up 75% of Americans' money. And then looking at, okay, what is the operating expenses to run my business? And then you're very clear on what that number is. And then you can then reverse engineer and say, okay, here's what I would have to do production wise in order to live the life that I want to live.
Exactly. And when you're a business owner, you have to reverse engineer. If say a W-2 employee, just an employee of any business, they have a set paycheck coming in every 2 months or every 2 weeks or however often, right? They have a set paycheck that they're receiving, and they can build their personal expenses around that set paycheck. When you're a business owner, you don't have a set paycheck. It's all based on you and what you do and what the production is.
Yeah. And this is like, it goes back to like this idea that the marketplace is unforgiving, and it was really going to reveal whether or not you're a good operator or not, operator of your house or operator of your business. Because usually when things get good, like let's say 2020 to June of 2022, like May, June, what people typically do is they radically increase their expenses, both in business, but also specifically on the personal side. They upgrade lifestyle, they upgrade cars, they upgrade houses, they upgrade vacations, they upgrade all this stuff. And they, and then when that changes, it creates a massive problem for them.
Right. Yeah. It's that lifestyle creep, and everybody is vulnerable to it. Not just, operators and business owners, everybody is vulnerable to that, because in times of plenty, it's really easy to be like, hey, I've got this money, I really want this thing, or I really need to do this, and, elevate those expenses and let them creep up. And that's not necessarily a bad thing. Sometimes you do want to increase your spend intentionally for a specific result, and that's fine, but you have to be aware of that, and you have to know when to scale that back down when the revenue coming in starts to change.
Yeah. I tell all of our coaching clients, like, you need to stay ready so you don't have to get ready.
Right.
And
exactly.
the other thing that comes up is like, always recommend, like I always propose and recommend, and what we do for us personally is 6 months of liquid capital, like at all times, no matter what, never touch it. And people are like, well, I could be using that money in some way. But I remember they talked to Warren Buffett, and he wants to keep like at least at minimum like 25 billion at any given time. And they were like, well, you could be earning better returns on that. He's like, yeah, but I own Geico, which is one of the largest insurance companies in the world. And if there's a catastrophe, I have to be able to deploy like $5 billion like at one shot. And that money in the bank allows me to sleep like a baby at night. Like I'm not concerned about that, right? I can't determine when that's going to happen because it's not a question of if, but I can do something about being prepared for it, right?
Yeah, you're preparing for a storm.
That's exactly right. Right. So now I'm wondering, you get to see all of these models. You get to see all these splits. You get to see all these franchises, and they all say they're the best, and we're the best, and we're the most amazing, and all this other stuff. But you see you see the nakedness of the money.
Yeah.
So without kind of, I guess, advocating for a particular franchise, or without, doing that, which types of vehicles do you find serve agents in terms of profitability? Because it blows my mind that I have some agent friends that are with companies that have a 15% split that never caps ever. And I'm like, bro, you're spending $115,000 a year on that. Like, what are you doing?
Yeah. What benefit are you getting? And I think that's a question that anybody should ask themselves when they're in, any given brokerage, whether it's a franchise or, a boutique brokerage, or even if they're independent themselves. What is this money that you're spending? What benefit is it bringing you? I think that everybody has a different priority in that regard. If you're with a brokerage that has no cap, make sure that brokerage is really providing you with other benefits to make that worth it. If you're just going to be paying them 10% forever with no limit, there better be something. There better be something that makes that 10% worth it. There should be some value there. And even the ones that do cap you, I really don't think there's really that much difference. You might hear all these various brokerages, and there's been more and more lately that are kind of starting to become more popular, but no matter what, you're still paying somebody, whether it's 6% plus a transaction fee, or if it's 10% off the top until this amount, or it doesn't really matter. You just need to know how much that is and whether they're bringing you that level of value.
Well, and I'm also aware too that if your intention is to scale, because we see how low these profit margins are, even at 19, 20%, that becomes increasingly more important, right? Because if you're trying to scale and go to, 3 million plus, which is what you have to get to in order for that to make sense, and that's a very large team. If I'm not looking at the numbers and I'm somewhere that doesn't cap, that's not sustainable. Like it's going to be very, very difficult to maintain profit margins. Would you agree with that?
If they don't cap, what's to stop? Like, there is no cap. You're just going to keep paying them, hundreds of thousands of dollars over the period of your life. So yeah, I think a cap is a good thing. But then on the other hand, you have people who are tired of paying their brokerages entirely and they just go independent. But that brings its own, difficulties with it. So, you become independent, you have a lot more responsibility, you have a lot more things to keep track of.
Like that, and you're not able to outsource the brokerage component, because if you go independent now, you have to check all the contracts, you got to make sure like everything's done, T's are crossed, I's are dotted, and like that sort of thing, which I think adds friction to scaling.
Yeah, and I mean, I guess it really depends on who's in place crossing those T's and dotting those I's. I think if you have a good structure internally, it's possible. But regardless, no matter what brokerage you're with, if you're scaling, you want to be aware of that percentage that's going out in your cost of sale, because it's
that's right.
Going to be different depending on what brokerage you're at. But, if you think about it, it's really dependent on your production as well, especially the ones who cap. If they cap you at say 20,000 or whatever it is, that could be 20% of your income. It could be 3%, maybe 3% is negligible to you. So I think it's an individual analysis. You have to do like a cost versus benefit, analysis on that.
Yeah, and then also what you're getting access to for whatever it is that you're paying for. I think that like technology is incredibly disruptive, and it usually pushes out middle people that don't carry their weight. Is what usually happens.
And oftentimes, what I find too is, you're paying this brokerage probably a percentage of your commission, and maybe also a monthly due to use their platform and their technology, and that's fine. But then I also find that a lot of teams purchase their own technology as well. Not only are we running through, say, Keller Williams or EXP or something that has their own internal tracking, we're also paying for Sisu, or we're paying for Brokerment, because the technology they're providing isn't meeting the need of that company.
It's interesting because it reminds me of a story with Carl Icahn. I don't know if you know who he is. He's like an old school investor, like a Warren Buffett type of guy. And he said he bought a company like in the 60s. It was a railroad company because their parts were worth more than what the stock was selling for. So he bought him, and he went down to their company, and they had 10 floors in New York. And he went to the first floor, and he's like, look, I just bought the company. I'd like to know what you guys do here. And I'm not like the most sophisticated person. I'm pretty good at math. Just like put it on a sheet of paper for me. And they're like, well, it's really complicated. Like, there's all these moving parts and da-da-da. So he leaves the first floor and he still doesn't know what they do. Goes to the second floor, does the same thing. What do you guys do here? Like, well, it's really complicated. It's esoteric, like all this other stuff, blah, blah, blah. He's like, okay. He spends a whole day doing this. After going to all 10 floors, he leaves and he still doesn't know what the hell they do. So then he calls, there's another department that's like in another state. And he calls that guy. He's like, hey, I want to come see you. But these guys don't want me to come see you. Just don't tell him I'm coming. Fine. So he goes out there. He talks to the guy, and the guy's like, like a down to earth type of guy, salt of the earth. They go out for drinks afterwards, and he's like, hey, I still don't know what the hell you guys do. Like, I bought your company. I don't know what you guys do. I went to all 10 floors. And the guy's like, well, I know what they do. And he's like, what? He's like, they do absolutely nothing. So you should fire them all. And Carl was like, that's not possible. Like, what are you talking about? Like, that sounds kind of ridiculous. So he flies back. And then what he does is he hires a consultant, like from like Columbia, pays him $250,000. He's like, I just bought this company. I need to figure out what the hell they're doing. Fine. It's $250,000. He's like, great. I'll give you your $250,000. They go. 2 weeks later, they come back with this giant book. It's like this big. It's all color coded. And Carl looks at them and says, look, I'm colorblind. Like, I'm not going to go through this whole damn book. Just put it on one notepad. Like, just, I'm good at math. Like, just show me what they do. And the guy's like, look, Carl, you've been straight with us, so we're going to be straight with you. We don't know what the hell they're doing. So what Carl proceeded to do, Christen, is he fired all of them. He took the lease of the building in New York, right? That was, and he sold it for 10 million bucks in the 60s. And he's like, you would think, like, if you fired the majority of the people at a grocery store, like something, like the bananas would be messed up, like something would be messed up. He's like, I didn't get one call, nothing. And I thought that was super interesting because he's saying that's equally as applicable today as it was then, whether that be in government, in big corporation, in brokerages, where there's a lot of this like dead weight. And if we look at the money and the percentages and all that other stuff, I think that's something to like really, really think about and pay attention to.
Yeah, I mean, it's that perfect example of that expense creep, right? You know, we're spending money on things and we don't really know what. I feel like specifically for realtors, a lot of that happens in that technology and that software. You know, that's something I pick on a lot when I'm discussing with clients is, you know, let's look at these expenses. Do you know what you're spending here? Like, what's in here? Do you use this? You know, we'll go through and we'll look at all these fees. Do you even use this? And he's, no, I don't even know what that is. And so then they have to run off to the, you know, the admins and the various people in the office. What is this? Do we use that? You know, and so I think being aware of exactly what fuels what piece of your business is important, you know?
Yeah. Yeah. And I think moving forward, as the industry continues to evolve and change, and as there's more of these sharp elbow competitors that are increasingly, they're using the transaction fee as a mechanism to push into the transaction, like the lead. But then what they're wanting to take over ancillary services. They want you to use their title, their mortgage, and all this other stuff. And as agents become more just technicians, where they're like servicing other people's leads, the profit margins, you're seeing it in the brokerage business, and you're seeing it in like the kind of at a large scale. And then you're seeing it at the agent level where the profit margins are being constricted. They're being compressed. So this conversation and having somebody like you that's looking over your stuff on a regular basis is super duper important. So I really appreciate you taking the time. This has been enjoyable. I think people are going to get a lot out of it. And for those of you who are watching, if you like this episode, be sure to watch the next one.
Thank you for having me.